if the really important thing is crypto right now is $2.7 trillion industry. It'll probably finish this cycle at $10 to $15 trillion. And by 2030 or so, it'll be $100 trillion, right? This is the largest, fastest accumulation of wealth in all human history. It's as simple as that. That's what that chart tells you. Now, what everybody does, and Howard, you explained, there is a bell curve. And you want to be on the left of the bell curve, which is actually the same as being the Jedi Master on the right of the bell curve. Everybody in the middle who overthinks it, it's simple. Number go up. That's the whole crypto thematic that you need to know. You can either do all the deep dive, and I must have done 10,000 hours on this, and I might be at the right side of the curve sometimes, but I don't mind being the left either. Just don't overthink it. The moment you overthink it, that's when you get yourself into trouble and you start not seeing it for what it is, you see it for what you want it to be.
Wait a minute, everyone. Welcome to Bitcoinzilla, your platform for daily cryptocurrency analysis and news. Our mission is to keep it simple. Bitcoinzilla offers engaging information that is easy to understand. Our analysts keep their eyes on the latest news to provide valuable insights via email. Don't miss out on this opportunity. Join our community of 10,000 subscribers and experience the new edge with Bitcoinzilla. Subscribe now. In today's video, Raoul Pal shares his prediction on the adoption curve of crypto and its potential to reach billions of users, the importance of building a network of trusted sources, and staying informed about new tools and technologies. So without wasting any time, let's dive into the video.
Is 80% of Bitcoin holders don't sell ever.
Yeah, correct. They're in cold storage.
And it's the same with Ethereum, with the staking and everything else. So your actual supply is 20% plus the miners. The miners keep getting halved every 4 years. So you've got no supply. So that's 20% of the let's say of the entire asset class, 2.7 trillion is actually available to buy. You bring something like an ETF and things go bananas, right? The more people who adopt it, the more the price rises. Also, the really key thing is, I don't know if you guys have ever seen the chart from Fidelity about the risk reward of assets. It's brilliant. So there's this big white page, all Fidelity branded, and here's a cluster of all of here's the NASDAQ, and here's gold, and here's oil, and here's all of that. They're all clustered in the bottom. Then there's a blank page, blank page, blank page, blank page, blank page, dot, Bitcoin. It's a alien asset class. We have never, ever had an asset class with this risk reward over a long-term time horizon and this performance in all of human history.
Bitcoin's price volatility for the last 30 days stands around 4%, down from nearly 18% in April 2013. It's starting to look more like a traditional equity. The clock is ticking on Bitcoin's halving, and it appears the ETF mania has accelerated the timeline of its arrival. Indeed, we have just a couple of weeks left before the big event. So it's no surprise that the halving is all crypto investors and media can talk about right now. But while we can still expect some predictable trading behavior in the wake of the big day, we're now in a very different market that calls for different trading strategies. Over the past 3 cycles, the halving has been all about the huge spike in volatility. We would typically expect a sell-off of 30%, 40%, followed by a stratospheric rise to a new all-time high within, on average, 480 days of the halving date. This time, though, the spot Bitcoin ETF has changed everything. To understand where the price of Bitcoin is going from here, it is the asset's volatility that we need to look at more closely. Over recent months, we have seen the anticipated drawdowns as pre-halving excitement builds. Yet these drawdowns have been anemic by previous cycle standards. This time, Bitcoin's corrections have been far shallower, not exceeding 25%. Indeed, the latest drawdown was only around 15% before BTC bounced back once again toward the $70,000 mark. This more muted sell-off is a harbinger of a softer rally once we're over the halving hump. There's little doubt that Bitcoin will see the customary sell-off following the halving, and it will certainly reach a new all-time high after. Equally, returns will still look a lot more exciting than they do for, say, traditional equity holders. But don't expect the more than 600% price increases we saw after the last halving in 2020. Those days are over. So why is this happening? There are 2 factors at play here. Firstly, the percentage of long-term Bitcoin holders has reached a record of around 14 million BTC. More than 70% of the total circulating supply of 19,670,043 BTC. Over recent months, record amounts of BTC have been withdrawn from exchanges to cold wallets as more and more holders adopt a diamond hands approach. But what really has led to a pronounced shift in behavior is the arrival of the spot Bitcoin ETF today. ETF are hoovering up more BTC supply from the market than miners can supply. On average, spot BTC ETF have taken in roughly 10,000 BTC per day since launch, while miners are only generating 900 new BTC every day. This is exacerbating scarcity and leading to upward price action.
Discovered this chart back in 2020, and what it is the number of active wallets in crypto.com measure this, versus the, active IP addresses of the internet. And I always thought, well, this is a network adoption model, the same kind of thing. It's an adoption of a technology. And I wonder what they look like. And I put them over each other. And what we found was that, obviously, because the internet was the rails that already exists, the adoption of a new technology that uses those rails is faster. And it's actually twice the speed of the internet. So if you can get your heads around how big the internet was for all of us, this is happening at twice the speed. It's driven the fastest appreciation asset of all time. The compounded annual returns of, let's say, Bitcoin is about 150% a year, even with 80% drawdowns 4 times in the middle of it. We've literally never been given an asset like this with an adoption like this. And going forwards, if we just assume that the rate of growth just matches that of the internet from here until the end of 2025, we end up with 1 billion users. And if we extrapolate that out to 2030, we get to 4 billion users. So basically, this is a pervasive technology that's going to take over all of our lives in ways we don't really understand. It's not just going to be about investing in cryptocurrencies. It's just going to be the underlying rails of transaction. Right. If I'm right that this is the fastest, largest accumulation of wealth in all human history, right? If it goes to 100 trillion, to JC's point, this is the S&P is worth $50 trillion, or the US stock market, entire US stock. That's 100 years of accumulated
It's
value.
mostly S&P, Raoul.
Yeah, it is. It's 100 years of accumulated value, and we're going to double that in a decade. It's like, this is la la land, right? The amount of money that's going to get made here is la la land. So what do they do with the money? I was speaking to a very famous hedge fund manager yesterday, and he asked his son this, and this guy's deep crypto, and his son is too. And his son's like 25, 26. He said, what are you going to do when you make your millions? He's like, well, I'll keep it in crypto. He's like, but when you take any money out, what will you do? He said, I'll buy property. And his dad was like, well, do you want to buy a super yacht or anything like that? He goes, no, it's a waste of money. So I'll buy property because it's an asset, and I will buy NFTs.
Crucially, though, this also means a drastic drop in long-term volatility, because ETF investors are far more long-term minded than the average crypto trader. Though we've seen a spike in volatility recently as we approach the halving event, it remains well below levels we've witnessed during previous halvings. CoinGlass data shows that the 30-day historical BTC/USD volatility has dropped from a high of nearly 18% in April 2013 to around 4% at the time of writing. You'd expect to see this percentage on a U.S. equity fund fact sheet, not a cryptocurrency price chart. This is because the investors coming into the spot Bitcoin ETF now are those same mom-and-pop investors and institutions who have poured trillions into S&P 500 ETF. They are long-term holders for whom 3 years is the minimum investment term, and their decisions to buy or sell an investment are dictated by long-term drivers, like macroeconomic conditions, structural market changes, and long-term return potential. So what does this mean for investors hoping to profit from the halving? They'll have to think a lot more like the traditional equity investor than the crypto degen. They'll have to swap Missouri for Morningstar, a global provider of data on traditional funds, to gauge the ebbs and flows of spot Bitcoin ETF assets under management. They'll have to keep one eye firmly fixed on what long-term holders are doing, because they are now the ones in the driving seat. And if they want those 600% returns, they'll have to look elsewhere. That's not what we'll see after this Bitcoin halving. The trade-off, though, will be steadier, more reliable returns that won't skew the volatility profile of a typical balanced portfolio out of all proportion. And for most investors, this is a much more appealing prospect than an asset that has a 50-50th chance of going to the moon or disappearing completely. And do not forget to subscribe to Bitcoin Seller. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you like the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.